Today we're going to talk about equity financing, and again I try to introduce every topic with a snapshot of or a high-level assessment of whether or the extent to which this topic is relevant in the real world. And the answer I'll give you today is that it's relevant for large companies, for example, as what's on the screen right now, Health Management Associates. It is not that relevant for smaller nonprofit organizations. So, but the concepts are still important. The actual calculations that we're going to go through today, you will not see those in the real world. It's the concepts behind them that are important. Again, that's my policy of full disclosure. I think it's sort of contrary to a lot of the debt financing calculations we've seen in the last few weeks, where those are exactly the kinds of calculations you will see in the real world. Equity is a lot more uncertain. So let's just quickly look through what is this screen telling us. So this is the website. This is Yahoo Finance, Health Management Associates, which is the second or third largest hospital management company in the country. Right now it's selling at $12.99. It's gone up 0.23% today, so I guess the shareholders of HMA think that we're going to get a debt deal. That tells you these are the kinds of data that investors will be looking at when they're making their investment decisions. So you can see, for example, there are bid and ask prices. That's what somebody's offering the shares at. Somebody's bidding at. When those two numbers come together, then a sale is made. The one-year target estimate, what that 1416 is that Yahoo Finance has a list of financial analysts, financial advisors that give them the market, what they think is their best estimate for what the price of HMA will be a year from now. And then Yahoo and Bloomberg does the same kinds of thing. They average all those estimates, and they come up and they provide that data on the website for investors. So what this is saying is that the investors, it's selling for about $13 a share now. The average of their financial advisors say that a year from now it's going to be selling for $14.16. So that is the estimated growth of the stock, according to financial analysts on Wall Street. So they get paid. Look at the beta. What does the beta tell you about HMA?
It's more volatile than the market.
Yeah, it's a much riskier stock than the average stock on the New York Stock Exchange. It's got a beta of 1.73, which means it's about 73% more risky. It swings in its prices go up and down a lot more than the average stock on the stock exchange. So what kinds of other things can we get? Well, over here on the right-hand side, it gives you some comparative data where it looks at what the current price is, how it's doing to similar size stocks. It has some key statistics, price-earnings ratios, quarterly and annual. It's got a PEG ratio, which is, we don't go through that in this course, but essentially it's an estimate of how fast the stock is going to grow. And then Bloomberg has similar kinds of data. It's got a little bit more information. It's got a dividend. It says a cash dividend on this line right here of $10. And that cash dividend will be paid on the dividend X date. X date means the date at which the dividend is paid. So it's going to be paid on March 2nd, 2007. I think that's passed. I think what that means is that that's when the dividend was first declared, and it's paid every year on March 2nd. I suspect that's what it means. But what that means is that the prices, what will happen to the price of the stock as it approaches the date it pays a dividend. Let me ask you this then. If the stock is paying $10 on the day before it pays the dividend, and that pays $1 dividend on the next day, will it also be selling for $10? Otherwise, you could just buy the stock the day of the dividend, before the dividend, sell it the day after for the same price, and pocket the dividend. Well, investors know that. So what will happen to the price of the stock as it approaches the date it pays the dividend? It'll go down, right? It'll go down until the day before it pays the dividend. The price of the stock plus the dividend will equal the price the stock will be selling for the day after the dividend. So stocks that pay dividends, the prices go, generally they go up and down all the time, but they will lower as they approach the ex-dividend date. So these are the kinds of information that investors will be looking at when they're making decisions on whether to buy HMA stock or not. So how can we use these data in what we're going to talk about today? So the first question we're going to answer is the mini case today. You're going to actually do one of the cases from the casebook today as your mini case. And what we're going to basically ask is specific healthcare stock overpriced or underpriced? In other words, will investors want to buy this stock at its current price, or would you want to buy them as a personal investor? So that's the question. That's why we're talking about what we're going to talk about. So this is essentially equity financing. Now, generally speaking, there are two sources of capital to any corporation, not-for-profit or for-profit: debt and equity. So the last 3 weeks we've been talking about debt financing. Today we're going to talk about equity finance. So in for-profit or investor-owned businesses, equity is supplied by the owners or the shareholders of the corporation. So the shareholders put up the capital, management then uses the capital, invests it in various revenue-generating activities, and then the investors get to share in the profits of that company. Not-for-profit businesses, equity, sometimes called fund capital, sometimes called net assets, is essentially supplied by the community and by retained earnings in the organization. So the community, or a church, or a university, or a county will put up the capital, and they actually, in effect, quote, own the hospital, but it's a not-for-profit business. So we're going to talk about the equity, the for-profit sector first, then we'll talk about the not-for-profit sector. So stock market transactions, essentially there's three types we're going to talk about generally three types. Initial public offerings, you've probably heard the phrase IPO. That means initial public offering. That is a company that's new or it's long been held by certain particular individuals. They decide to go public. And going public essentially means they sell shares to the public for the first time. So what was the most notable IPO of 2012? Facebook. What was the most notable one that's going to happen this year, I think, isn't it?
Twitter.
Yeah. So those are IPOs. They're traditionally, historically they've been privately held by a few individuals. Now they're going to the market for the first time, the initial time. The primary market is now Facebook. Shares are out there, they're trading, and so people, if Facebook wants to issue more shares, then it can do so, but it would sell them in the primary market, which means they already are publicly held, but they're going to issue more shares. And then finally, there's the secondary market, and that's the trading that we just saw a minute ago, where there's shares that are held out there by the public, by corporations, and they're trading with each other. That's called the secondary market. So there's some real advantage. I'm not going to go through all the institutional detail around common stock. You can read that in your textbook. Instead, I'm going to skip right to the why we have common share, why do for investor-owned corporations issue common stock. And the first one is no fixed charges. So what does that mean?
Not like a monthly interest payment like with debt.
Right. So debt, as we talked about last few weeks, requires debt is a fixed charge. There is no option. You must pay the principal and interest payments as they come due. But dividends on common shares is not a fixed charge. Management can elect, if it wants, to skip a dividend. It will not put the company into bankruptcy by skipping a dividend. Skipping an interest and principal payment could put the company into bankruptcy. So common shares have the advantage of being a source of capital that doesn't have a fixed charge associated with it. No maturity date. What does that mean? Julian.
Maybe the organization doesn't have a obligation to pay it back.
On a certain date. That's right. It's permanent capital. When you go into the bank and you borrow, that is a maturity date. Or if you issue a bond, that has a maturity date. On that date, you must repay the value of the bond or the value of the loan. Common shares do not have to be repaid. They are forever. Creates additional debt capacity. That's not so obvious. What does that mean? You look like no. No? Shell.
If a company is public, then they can take on debt more easily.
That's right. So what we mean by that is bankers will look at your company or your not-for-profit, and they will say, given your capital structure, given the amount of equity you have, we will lend you this amount of money. So by issuing more common shares, bringing more equity, more capital in the organization, essentially that creates a higher level ability to borrow in the future. And finally, it may be easier to sell. Why do I say that? Why might common shares be easier to sell than borrowing?
Because they're publicly traded, there's a lot of information on them. And I was in the book, it was saying like when stocks are traded like just between private parties, it's a lot harder to sell those if you need to.
Okay, so if I'm an investor and I'm looking at the stock of HMA or I'm looking at the debt of HMA, why might I prefer the stock of HMA over the debt of HMA? I mean, I agree with what you just said. I'm just trying to get more specific. Robbie?
Higher returns?
Yeah. Historically, the stock market has had higher rates of return than the debt market. So debt markets are, bonds provide you a fixed rate of return. Stock markets, generally speaking, over history have had higher rates of return. So that's one reason. What's the second reason?
Is it more short term? Like it's not as long of a commitment.
Why would it be? If HMA, if it's selling for $12 today and a week from now it's selling for $14, you're saying you could sell.
There's faster turnaround.
There may be the possibility of higher capital gains in a short period of time. That's true. I haven't really thought that through, but that's right. What does Uncle Sam look? How does Uncle Sam look at? Sorry.
You're only taxed on 30% if you're a company, right?
Right. So there's preferential tax treatment on dividend income compared to interest income. Interest income is taxed at normal rates, and dividend income is taxed at a much lower rate for most investors. So there's tax advantages to investors to buying common shares over debt. And again, this is historically the reason for this has been to give investors an incentive to invest in corporations and the growth of the country versus debt, which is a fixed rate of return, but not as speculative, as it were. Some of the disadvantages of common stock. Dilutes control. What does that mean?
The more investors you have, the less your vote counts.
Especially if you issue new stocks. Especially if you issue new stocks and new people come in, they get a better, they can have more control as far as participating, and also there's something with the stock. Let's say if you bought it, if you're an old investor, if you bought it at 100 shares and then it changes where it's now being sold at 75, so the old investors don't get that same investment of $100 per share. It's reduced to like 75.
Right. Okay, let's talk in generalities. How is Mark Zuckerberg's life different today than it was a year ago? 2 years ago?
He has to answer to more people.
He has to answer to people because people out there now have a vested interest. They have ownership, part ownership of the company he started. So he doesn't have total control of Facebook anymore. He has to answer to the stockholders, the people who hold shares in his company. So I think what Julian was getting at was usually the second one, which is dilutes the value. So when you issue new shares, essentially you've got the same earnings stream, but you've got more shareholders. This is what you were getting at as well, Jennifer. You've got more shareholders sharing in the same income stream. Now hopefully management will take the additional capital and invest it and increase earnings even more so than what they would have been without the capital. But until that capital, the return from that new capital catches up and starts to pay off in earnings, essentially the value is diluted. Issuance costs are high. What does that mean?
Pay bank. For fees, the IPO probably.
Because don't you have to register it with the SEC?
Right. Issuance costs are high because stock issues must be registered with the SEC. There's all kinds of paperwork, reporting requirements. Generally speaking, the cost per dollar of common shares issued, I think there's a table in the book that shows it's $2–3 per $100 of worth of value. So issuing stock is much more costly than going to your local bank and floating a loan, where essentially you're just signing a document, promissory note with you and the bank. And then finally, negative signaling. What does that mean?
So like when you issue new stock, you're telling the market perhaps that you have different information about your company that they don't know, and they might think that your financial situation is poorer than what is currently being, what information they have.
So I agree with that, but why might investors think that?
Because you need more money.
Well, but I could be growing really fast and I have incredible thirst for money.
Because companies are going to have an incentive to sell a stock when their stock price is overvalued,
Right.
because they will get more money for the same number of stocks. So if as management you're selling stock right now, investors would see that you're doing it because your stock is overpriced.
Exactly. Management will not want to issue new stock when the market is at a bottom because they'll get relatively little money per share. Management will want to issue shares when the price is at its highest, and perhaps too high, because that's when you get the maximum amount of cash in for the shares that are sold. So as soon as companies announce that they're selling new shares, that usually leads the day after to a fairly significant drop in the price of the stock, because that's giving investors information.